strong. The U.S. dollar affects all those names, okay? And it's been an 8-month roller coaster ride that really has Wall Street divided. Just last week, Goldman Sachs, stunned with its dramatic forecast calling for the euro to hit parity by September. You already heard that from Howard Lutnick at Cantor Fitzgerald here on this show. But you see the dollar falling to 80 cents by the end of 2017. That's from Goldman. On the other hand, you've got British bank HSBC boosting its euro forecast to $1.20 by year end. Okay, who's right? And what does that mean for your portfolio in the year ahead? Joining me now, Andy Brenner, National Alliance Securities Head of International Fixed Income, and Kevin Giddis, Raymond James, Head of Fixed Income Capital Markets. Okay, we're going to whirl right through this, and we begin with the dollar. Who's right, HSBC or Goldman Sachs?
HSBC.
Really? Why?
Because what you're seeing now is with Yellen's testimony this week, she's basically taking the Fed raises off the table from an immediate standpoint. So right now, June's not in the cards. So if the Fed isn't raising rates, the dollar's going to be a little bit weaker. Plus, the euro has been so low for the last 6 weeks or 3 months, actually, that the export growth out of Europe has really expanded quite a bit. So you're going to start seeing numbers of German GDP growth and so on and so forth do better. So I think the euro is going to do better. I see it as a low of 104, which is what we've seen, and I see it as a little bit of resistance at 112, but I think it's going to go to about 117.
Kevin?
Yeah, I'm not far off of where Andy is. I don't think we'll reach parity at all, but I do think on the upside, 115.
So the almighty Goldman, Howard Lutnick, these guys are wrong? I mean, he's been right and right and right on the strength of the dollar.
Yeah, the conditions that would have to take place to get to 80 cents, I just can't see, given where we are in the cycle right now.
Okay, now let's get to oil. Kevin, oil has continued to plummet. Today it happens to be strengthening because the dollar got weak, but if that dollar weakness continues, does that mean that oil has seen the lowest levels for now?
Well, you're asking a bond guy about oil prices.
Yeah, I'm
it's
forcing
really
you,
tough,
Kevin.
isn't it? You know, and I think oil has a little room to fall, but I don't think we break 40. I don't think we get into the 30s, but I don't think it settles above 50 or 60 before the end of the year.
I kind of hope we do, Andy, but that's just from a consumer standpoint.
Well, from a consumer standpoint, that's one thing. But the reality is, if you can't have a U.S. economy that's strong and a Fed that's lagging as far as raising rates and trying to push GDP up and so on and so forth, and then all of a sudden have oil be all that weak. I mean, you've had refinery strikes. You've had all kinds of reasons. You've had a surplus of oil in Cushing.
So
I tend to think
$15 higher than where we are now.
Yeah, well, you asked me for year end.
Yeah.
I mean, I think you could easily get to 60, 65. As to where you are year end, I don't have a clue, but I think that's the next level you're trending towards.
Okay, now let's get to Kevin's real bailiwick, and that's fixed income for both of you, really. Sure. But let's start with something, I don't know if it's easy, but the 10-year here in the United States.
Yeah.
Would you be putting money into this right now?
You know, it's tough to go sub 2% investment in 10s right now, but when you look at all the money that's coming in from
yield is ridiculous, but you're calling for a 2.4% yield by
year end, and that assumes that the Fed does take action in September. I do not see anything before then, and I'm on the cusp of whether they do anything at all in 2015. But assuming that September comes and goes, we could see 240, which is, it's less than 50 basis points.
Andy starts to yawn when we ask him about 10 years in the U.S. because he's looking at 10 years in Greece with an 11% yield. Do you still like those?
I do. In fact, from the time your people called me this morning to the time it closed, it was up 5.5%. I mean, that's a year's worth of returns. I mean, that's how volatile Greece is right now.
Are you going to get paid back in 10 years?
Are you going to get paid back in 10 years? I'm not going to stay in anything for 10 years, okay? I'm a trader. I'll stay something maybe 10 months or 10 weeks or your Warren Buffett 10 days or something like that. But no, I think you're going to get paid back. I see the Greek government changing. As far as what Kevin said at 10 years, I think you're in an intermediate range of 186 to 202. I look for the 10-year to be somewhat similar to where he is at year end. The difference is I see 2 Fed increases between now and year end rather than one.
You see how many Fed increases, Kevin?
I just see one. The Fed can go at any time that they want to, and I know they want to come off of zero.
Are you saying December?
I'm saying September at the earliest,
okay.
Yeah.
All right. You know what? Poor Kevin. He came from Florida, and now he's looking outside the window with a snowstorm right now. Andy's saying, tough. You can see it behind me. It is definitely snowing right here. Our sincere thanks to Andy Brenner. Thank you so much. Andy's National Alliance Securities Head of International Fixed Income, and Kevin Giddis, Raymond James Head of Fixed Income Capital Markets. Wonderful.